Welcome to Quants with Cash. Today we are looking at performance metrics to define how good your strategies are. Let's imagine a trading strategy which buys at the break of the previous high and also has a fixed take profit. How do you think the strategy performs? Does it perform good enough so that you can live trade this strategy? In this video, we'll be seeing at the performance metrics which can define how good the trading strategies are. One performance metric that you might have heard being used a lot is Sharpe ratio, which is defined as average returns minus the risk-free returns divided by the standard deviation of returns. Every strategy would have an equity curve, which when plotted would look like this. If you look closely, these are the individual trade returns, which are cumulatively summed up to form the equity curve. There are two ways of calculating the returns. One, the close minus the previous close divided by the previous close, which will give you the percentage returns. But there is a more accurate way of calculating the returns using the log returns, which is just the log of close divided by the previous close. The log returns follow a normal distribution, and hence we'd be using the log returns. We just collect these returns together and try to create a histogram of all the returns, in which we are just counting how many times did we have an occurrence of the return within an interval. If you try to fit a normal curve on top of these returns, you're going to get a curve like this. The mean of your normal curve would be your average return, and the standard deviation would define 68% of the returns. Hence, our Sharpe ratio would just be average returns divided by the standard deviation of the returns. Notice how we eliminated the risk-free returns. The risk-free returns are only there if you park your money in some risk-free asset, which is going to give you returns when the capital is not deployed in your strategy. Now let's go back to our breakout strategy. If we plot the equity curve of the trade returns, it's going to give us such nice looking equity curve with a Sharpe ratio of 7.9, which is just fabulous. But we must ask ourselves, is the Sharpe ratio being so high justified, or are we making any mistakes? And that's the reason why we must calculate the equity curve using the individual candle returns and not the trade returns. We see a dramatic change when we start using the candle returns, and our Sharpe ratio drops considerably. We also see that it gives us a true sense of how the strategy was actually behaving. Since we are dealing with the candle returns, in order to analyze the Sharpe ratio, we must multiply it with the square root of the number of periods in a year. So for the hourly candles, it just becomes multiplied by the square root of 8760, which is the number of hours existing in a year. But we need to ask this, do we really care about the variability in the positive returns? Or should we just focus ourselves on the variability on the negative side of the returns? The lesser the variability on the negative side of the returns, the better it is for the strategy. Using this idea, we can formulate a new performance metric, which is called as a Sortino ratio. Sortino ratio is defined as the average returns divided by the standard deviation of the negative returns. Looking at the equity returns, it's also good to know what happens in the worst case. It gives us a measure of the tail risk that the strategy can have. Value at risk measures the fifth percentile return. Hence, it would just mean that you would see returns worse than value at risk 5% of the times. Value at risk is colloquially used with the percentile. So one can say value at risk at fifth percentile, or one can say value at risk at 8th percentile. Value at risk can help you size positions and leverage. If the returns were worse than value at risk, how bad was it on average? The conditional value at risk measures the average of the last 5% returns. The severity of the conditional value at risk can help you size your position better. A strategy with higher Sharpe but worse conditional value at risk may still blow up. Since we are dealing with the candle returns, The value at risk measures how steep is the steepest expected slope on any given step. But to measure how far down the hill did we actually end up from the peak, we calculate the drawdowns. The maximum of these drawdowns is called as the max drawdown. The max drawdown can tell you how bad does it get when your strategy goes into drawdowns and can help you remain confident when the actual drawdown occurs in the future. Hope you enjoyed this video. In the later videos, we'll be designing trading strategies with the help of these performance metrics.